Good morning and welcome to this Monday, June 5th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we exited last week in style, had a big run in a number of different areas in the market, but especially we saw rotation out of some of the growth areas that have been leading the market, not only in 2023, but really, excuse me, with a big push in May. But here in early part of June, we're starting to get a little bit more rotation back into some of the other areas of the market, which I find to be very bullish. We had a couple of things that I guess could have happened. We had the big stocks leading the market in May, had a lot of folks saying, breadth is horrible. And so one of two things normally can come out of that. You can either see the market drop because not enough participation, or you can see those leaders pull the rest of the market with it to the upside. And we got the latter on Friday, where we saw many areas that had been beaten down, had not been participating, had massive rallies. And that's what you want to see in a bull market. You want to see the wide participation. When the money leaves the leaders, does it leave the market? Or does it rotate? That's a really big question that has to be answered, and it only is going to be answered when those leaders start to falter. And we saw some of that at the end of last week. Semiconductors, not very strong last week. We had a lot of those that had been leading the market to the upside, took a big hit. But that money didn't leave the market. Instead, it rotated into value. That's what happens in bull markets. And it's why, for me, I think talking about breadth is pointless until you get the market to cooperate and move to the downside to support it. We never saw any of that. Market stayed up. And instead of the market faltering because leadership stocks falter, the opposite happened. We had those laggards step up and lead the market at the end of last week. So I thought it was very bullish action. Looking today at the futures, we've got kind of a mixed bag, pretty close to the flat line. We've got Dow futures down 8, S&P 500 futures up 1, NASDAQ futures down 18, crude oil prices up $1.85, back up to 73.58 per barrel. That's up 2.5% this morning. That continues. I mean, we were, I don't know what we got down to last week, $66, $67 a barrel, maybe something like that. Anyway, back up to 73, almost $74. U.S. 10-year Treasury yield up 5 basis points, 3.74%. I've been watching the yields, and I don't know if we're just kind of in a new normal with the yields. I mean, we had the big drop in interest rates during the pandemic, and then we saw once things started to heat back up again, and we got the economy open back up, we saw rates moving back higher, and then we had some temporary inflation issues that sent the interest rates even higher. Now I'm just kind of watching to see. I mean, if I had to lean one direction or the other, I would think that probably over the course of the rest of the year and maybe into next year, that we would see lower rates. But I think most everyone now is recognizing that the Fed is pausing. Personally, I think they're done, but they're at least pausing. They've been making that fairly well known, and I think that's what we'll see at the next meeting next week. But I'm wondering if we're just going to kind of get back to the normal, 3-4% kind of a 10-year Treasury yield. That's still an incredibly low rate. I don't think we need to go back down to 2.5% to support the stock market. But now that we're seeing the growth slow back down a little bit and see some of the money rotate out, and we've got the 10-year Treasury yield still hovering, still actually rising back up again today, another 5 basis points. I'm just wondering if we're just maybe going to have to, trying to think of the right word, but just recognize that, those crazy low rates were crazy. Kind of like when we were back in the 1960s. Of course, I wasn't looking at the markets back then. But back in the 1960s, we had very, very, very low interest rates. I remember my parents used to talk about having their mortgage at, 3-4%. And when I first bought my first house, it was 10%, I think, in the late 1980s. So I don't know. I think maybe I'm open at this point to interest rates just kind of being a little bit higher. I'm just going to continue to watch this. I think that's probably the best way to look at it. Now, obviously, I'm not going to be interested if interest rates get back up, say, to 5%, 5.5%, because historically that tells us the thing is investors have a lot more choices at that point. Doesn't necessarily mean the economy will be bad, but if money flows away from the stock market, prices aren't going up. And I think if you get interest rates up to that level, I mean, I have to admit, I looked the other day, I got something in the mail and there was a CD. I didn't really pay that much attention to it, but I saw 5.5% on it. Or maybe it was 5.25%, but I'm like, wow, that's a pretty good rate. Not to have to worry about. And I'm sure there's a lot of folks out there. I mean, I'm a pretty aggressive investor, but I'm sure a lot of folks out there thinking more about safety and looking at that probably a lot harder right now. And so as rates go up, that's the thing you have to worry about. It's not necessarily a slowing economy. The economy can stay strong with rates moving up. It's about investors having choices and moving elsewhere. Anyway, we'll see. I just find it interesting that the 10-year Treasury yield has kind of plateaued, I guess. We got up to 4.30 and then we came back down. We were in a downtrend, but we keep seeing these false breakdowns, false breakouts. And so I'm beginning to wonder maybe if we're just kind of moving into the new normal. Anyway, just a couple random thoughts there. Looking at the Friday action, the Dow Jones Industrial Average was up 701 points. S&P 500 up 61, NASDAQ up 140, mid caps up 79, small caps 46. That's up 4% on the S&P 600 small cap index. Now, I do historical research on the Russell 2000, which is also a small cap index, but it's not the same. For instance, on Friday, I think the small cap index, the Russell 2000, the IWM, I think was up like 3.5%, whereas the S&P 600 was up 4%. But I've got the history on the IWM. And so I went back last night and I was looking, and 4% gains don't come along very often in a day on the small cap index. On the Russell 2000, it's happened one time since 2020, prior to yesterday. It was actually in November of 2022, I believe I saw. That was the only other time since the pandemic. When anytime you get a pandemic, get a crash, mini crash, financial crisis, you get tremendous volatility. So you have big down days, and then when the market rallies, you have these big up days. We've had plenty of those where we've had the small cap index up 4%. But when you're just kind of humming along in a market and there's really, volatility has been going down. I mean, I don't know if you paid attention to the VIX, that's down 14s. I mean, really low, which is awesome, because no bear market. Well, I'm going to correct this in just a second, but let me just say this. No bear market has ever seen a VIX go down to 14 in the 14s. Actually, never seen anything go below 16. And then within that same bear market, go down and set another new low. If it did it this time, it'd be the first time in history since I've been studying the VIX and studying the markets. Now, the one exception was back in 2003. Remember, we were in a secular bear market, and we came out and we went into that cyclical bull market for 4 years, 2003 to 2007. And the VIX went down. I don't know where it got down to. It was lower teens. And then, of course, we kept going in that secular bear market. And 2007 to 2009, we went down to new lows. So that was the only exception. But that was a 4-year cyclical bull market between the two. I mean, we bottomed in October. So we've been going, doing this now for 7 months back to the upside. This would be the first time that we have seen fear come out of the market that much and then go to another low within basically that same bear market. So I had been saying a while back that when we saw the VIX drop below 16, that was yet another bullish confirmation. And I think right now, I didn't look, but I believe it finished 14 and change or something on Friday. So that's a good sign. Materials led the way, up 3.35% on Friday. Energy, 3.04%. Industrials, 2.91%. Discretionary, one of the key aggressive groups, did finish up 2.35%. Made a nice breakout too, by the way. And financials up 2.18%. So other than discretionary, financials, industrials, energy, materials. These are all groups that were not participating. Here comes the rotation. So all of a sudden, materials climb right back up above the 20-day moving average. Energy does the same. Industrials broke a downtrend line.
Tom.
Yeah.
You need to share your screen.
Oh, shoot. It's Monday. I apologize. Yeah, most of that, fortunately, I was just talking, so I didn't really show charts. But here, let me just go back. So you got the Dow, S&P, all the major indices across the top. And essentially, I was just showing the percentages. Small caps, 4%. So you can see that huge move there. That was the big leader from Friday. And then I was just showing the energy right here, or materials, energy, and the rest of the sectors that were leading. So discretionary right here was the fourth best on Friday, but it was the only one of the aggressive sectors that were in the top 5. The others, like I said, financials, industrials, energy, materials, all sectors that have been beaten down. So I was mentioning right here, materials moved back up above the 20-day. Energy back up above the 20-day. Industrials breaking this downtrend line right here, moving back up into an area of congestion. A follow-through day on industrials here or next few days, get back up above 104. That would be extremely bullish for industrials. Discretionary already breaking out, but discretionary has been doing well, but it hasn't been doing as well as technology and communication services. So there are plenty of areas within discretionary that have not been participating. We started to see some of those areas participate, which was good. Financials in this downtrend looks to me like it broke the downtrend line coming up. Clearing 33 and especially about 33.5 would be very bullish for financials. And watch the banks within the financials. That would be a key move to the upside as well if you get the banks moving along. Not really a whole lot else to discuss. All 11 sectors, by the way, were up on Friday. So nothing was lower. I think the worst performing sector, communication services, it was barely up. But again, that's the rotation that I'm talking about. Those stocks, they had been crushing the market for so long, they took a breather, a well-deserved breather. But fortunately, when those areas were sold, the money didn't come out of the market. It rotated. That is the hallmark of a bull market. If there was one thing I could point to, I mean, obviously uptrending prices, that goes without saying, but it's when leadership falters, other leadership steps in to carry the market even higher. Again, that's what we saw on Friday. I find that to be extremely bullish to support the bullish thesis I've been talking about now for almost a year. Now we're starting to see, honestly, if these groups begin to break out, industrials take out the high, financials get back up through 33.50, materials hold this double bottom and break out above 82. That's the key level now with a double bottom in play. Energy never quite got a double bottom, but moving back up, clearing 87.5 would be huge. We start seeing breakouts like that. It's a melt up, folks. When I first started talking about the potential of a bear market at the beginning of 2022, and I remember at Market Vision 2022, I laid it out, and it's still very clear. I thought we were going to go straight down for 6 months and then right back up the next 6 months. That was my initial forecast. And it looked perfect. We went down through June. We were right back up through August. Remember, 2022, it looked great. And then my buddy, Fed Chief Powell, said there's more pain ahead. I think the market lost a lot of confidence in the Fed at that point. We went down, we got our double bottom. Actually went just a little bit below the June low. But since then, what's happening? I mean, we're getting exactly what we had talked about. Down, back up, and it's starting to strengthen. It's starting to pick up steam. We saw massive rallies in the growth stocks. Now, let's see if the value actually led us out of the October low, if you recall. Value stocks, industrials, financials, they had great second half of October, great November, led pretty much right through the end of the year. And then they passed the baton to technology, communication services, and maybe to just a little bit lesser extent, consumer discretionary. And since then, since the beginning of the year, they've been carrying the baton. Well, this past week, we may have been seeing a little bit of a shift, another passing of the baton for the next leg of this relay. That wouldn't surprise me at all. I mean, growth stocks made a huge run. We've seen some of these stocks, NVIDIA, my gosh, back to all-time highs, just massive moves. Folks are going to take profits. And once the tops are in and we start moving down in some of those other areas, you're going to see either money leave the market or rotate. Like I said, so far we're rotating, which is good news. 10-year treasury yield. So this is what I was talking about earlier when I was just rambling about maybe this is the new normal. I mean, I'm just kind of watching this, and we've just been consolidating. You know, every time I think, okay, we're rolling over, we're going to go back to 2.5%. We come back up. Then we roll over, and I was like, okay, now we're back on track 2.5%, and we come back up. I'm not quite sure. Rates are low. I don't talk 2.5%, 3.75%, whatever. Historically, these are incredibly low rates. Just about any other time in history. I mean, we look at this now, we're like, oh my gosh, rates are going up. Any other time in history, if we said, hey, would you like 3.75% 10-year treasury yield? I think every other point in time in history would have said, yes, we would love that. But now, because we've seen almost 0% interest rates, we look at 3.75 like, oh my gosh, how's the market going to handle it? Well, the market handled 5, 6, 7% interest rates for many years. I think 3.75% is fine. But do we just meander here? I don't know. This one has me a little bit more perplexed, and I don't really trade bonds, so I don't look at it nearly as closely as I do the stock market. I don't do nearly as much research. I just pretty much follow the technicals and gut instincts and that sort of thing. And I don't know, 3.75%, maybe that's going to be the new norm. S&P 500. So the S&P, nice breakout again. Those watching 41.79, which I was in that camp, that is now come and gone easily through that. I thought once we got through 41.79, 43.05 was the big level. I thought we would eventually get up there to test it. Well, we finished 42.82, only 0.5% away from testing what I think is the biggest number on any chart, because I think the benchmark is the S&P 500. And if we go to a weekly chart, low, lower high, lower low, lower high, lower low. The last lower high was this August high. If we break out above it, I mean, I've said it's coming, it's going to happen. But to me, that's like the final nail in the bear's coffin. You get through 43.05 and you can't even look at the long-term technicals anymore. I mean, there it is. Lower low, lower high, lower low, lower high, lower low. A bear market is just a series of lower highs and lower lows. Get back through 43.05 and that series is over. But I don't like to wait for all the technicals to line up perfectly to declare a bear market over. I think we get plenty of signs. Certainly talked about them. at length over the last year. I don't think you have to wait to see 4,300, 4,400. I don't think you need to wait to see an all-time high for you to recognize that, oh, bear market ended. A lot of signs have already pointed us that way. Many, many, many signs. So 4305, watch that one. That's going to be a key level to get through. NASDAQ 100 already through the August high. I mean, you look at a weekly chart here, I don't know what you can see but bullishness. I mean, if anything now, it's starting to look like off of an uptrend that this is just a lengthy cup, that the bear market just started a deep cup, turning back up. Weekly PPO, I mean, could it be much stronger? I mean, nobody argued when we were rallying here in 2020. We just kept going, right? Look at that PPO just pointing straight higher and higher and higher. Look at what we're doing right now. And I really like the monthly charts. Perfect. Right at the very top, we had a negative divergence. What do we talk about with negative divergences? Center line tests, 50 period tests. We got that on the monthly charts. With a negative divergence, we went right down to the 50-month moving average, right down to the center line, and here we come, roaring back up again. Nice little crossover for those of you that like to trade off crossovers. I don't see bearishness. I don't know why anybody wants to try and stick. I mean, sure, you want to throw out some fundamental reasons, go ahead. Market doesn't care. Market's looking ahead. Doesn't care what we're facing fundamentally right now. I would argue that it was already built in with the bear market we had in 2022. Look at the Russell 2000. This is the one I've been waiting on. I mean, if you can go back and look at the structure of all of these previous bottoms, but basically it's a drop, a rebound, and then a little bit of consolidation before a breakout. Drop, rebound, little bit of consolidation before a breakout. We got a false breakout here, by the way. And we've seen that quite often. Here, a drop, a rebound, consolidation, false breakout, move down, then a breakout. This one was lengthier. But for the since March, I've been talking about in every area, but especially small caps and mid caps, money has been rotating to growth from value. So those who have been looking for this to break back down below these prior lows, I would argue, why in the heck would Wall Street firms be moving into growth versus value this entire time? You want me to show you? Let me show you what we've been looking at here. So we can just pull up the Dow Jones US small cap growth versus value. Just put it on a line chart. Make it nice and big. Everybody can see it. I mean, as we went down here, especially into this drop, look at the rotation into growth. This is growth versus value at the small cap level. And as we've been consolidating, you can see we actually just made a recent 52-week high. That's bullish. What's the story? I mean, I don't understand the story that the market's trying to tell us here unless it's bullish. Why do we see money rotating heavily into growth during this period of consolidation? The other thing I would point to with the IWM is look at a long-term monthly chart. What's wrong with this picture? False breakout here in October, negative divergence, center line test, 50-month test. I still see an uptrend. Double top right here at 160 or just above 160. Where did we come down to? We had the big breakout. Isn't this TA 101? Price resistance becomes support. I mean, if you go back down, if the IWM goes down and breaks down below 160, I will be here to tell you that's a bearish development. And if there are other bearish developments, maybe things are changing. But all we did was break out and retest the breakout level. I think we're ready to go. I've had questions. Why would you get into the triple small cap ET? Why would you do leverage into this? Well, because it's sitting at a major support primarily. When would you like to get in? After it's already gone up 40%? We did the same thing with the stocks on the daily chart a couple months ago before the semiconductors had their big run. I pointed out the hammer right here to members. See all this congestion right in here? This high over here was 7,200. This one got up, I don't know, maybe 7,350, 7,400. 7,200 to 7,400 was resistance. We went right back down and tested the level and put in a hammer. And it was right there. I talked about the SOXL. We were at 7,250 on the semiconductors. Look at the SOXL. So if you had gotten in at any point back in this range, 13 to 15, it's up 50%, not less than a month. Well, about a month, maybe 5 weeks. So when I'm looking at the IWM and I'm seeing it down, well, literally all this area, I've been talking about it for a while. I was in a full position right here because I thought we were making the breakout. And when we failed to hold, I sent out a special message to members 30 minutes before the close. And I said, we've got a false breakout. And the TNA shares that I had added on that breakout, I sold. I took a small loss. Why? We got a false breakout. We've seen false breakouts. There's a false breakout. We go back down. Here, we tested the level, went back down. When I see a false breakout, last thing I want to be is in a leveraged ETF. So I said, getting out, I'll get back in on weakness and try and that's what I did. Back in this area right in here, I built my TNA position up again for that breakout. I think we're going to run. Now, I mean, could we pull back temporarily? Sure. I think 179, 180 wouldn't worry me too much. Below 179 on a close might start to worry me a little bit. I probably would pull back a little bit on my TNA. I can always add it later. To me, these leveraged ETFs are like fire. So I don't want to get burned up in them. But I do like being on a heater. And so looks like from Friday, maybe we're going to start a little bit of a heater here. Anyway, IWM looks good. Let me talk a little bit about the XLI, because the XLI right here, downtrending, breaking back up above that downtrend, which is nice. I mean, if we get over 102, we're going to be at about a 3-month high. And if you get over 104, it's a breakout. Watch the XLI, because if this rotation continues, we saw how fast semiconductors and many of the technology stocks went to the upside, the mega cap. Same thing can happen here. A lot of traders have short memories. Look at October and November. You see this? Yeah, technology wasn't doing anything back then. Look at the XLK during the same period, October and November. Yeah, we went up a little. XLI killed the XLK. When money rotates, the problem is a lot of folks see all that strength that's been in technology, and then they want to jump and just stay in technology. And then watch as the rest of the market catches up. You got to pay attention to this rotation. XLK has been on fire. It's okay for it to consolidate for a little while. I think it's still fine to hold on to some QQQ. I have, but I'm not leveraged in it. This is the area: industrials, financials, healthcare, energy, materials. These are areas that have been beaten down to a pulp on a relative basis. This is where we could see the next big move. And so anyway, transportation, part of the industrials. I mean, it was only a couple of days ago. It may have been Wednesday or Thursday last week. I actually put this chart out there to our members at Earnings Beats. And I said, watch this trend line. I said, really be bullish if we could get through it. Friday, we went through it. All right, market getting ready to open. I want to show you a chart of the day before we get into anything else. Here is, if you scroll down at earningsbeats.com, you can sign up for our EB Digest, name and email address, all it takes. Hit that subscribe button, comes out Monday, Wednesday, Friday. 2 paragraphs in a chart. That's how I like to describe it. Very simple read. Try to make it educational, try to make it informative. Sometimes it's about individual stocks. Sometimes it's about just the overall market, what I'm seeing in the market. Today, I did a little different one. I did an RRG chart, and I'll show it to you. So with this RRG, this is the PSC, which is a small cap benchmark. And here are all of the PSC ETFs that track the various sectors, small cap sectors. Well, you'll notice that right now on the 1-year daily where we sit, this is information technology over here. That is way to the right. This is the relative strength line coming horizontal. So when you get way over here, small cap technology is crushing all of the other small cap ETFs. The other one that I like though a little bit is this PSCI. You can see it's coming down into weakening, but a lot of times what will happen, and I'm going to lengthen the tail here. And then I'm just going to click on the industrials. So it just kind of highlights it. But you can see we were in lagging, went through improving, rolled right up into leading, came back down in weakening. But a lot of times what you'll see is during the weakness, money goes elsewhere and then it comes back. So I would not be surprised to see the industrial, small cap industrials start to turn back up into the leading, because this is the way we normally will move. This is the way you do move through this RRG chart. Always, when you're strengthening, you're moving kind of in the northwest fashion, northeast fashion. And when you're weakening, you're going back into southwest. But a lot of times you will see it come back down and then turn right back up again. So anyway, keep that in mind. Obviously, technology has been a great area, not just for large caps, but also for the small caps. If you want to know why small cap growth has been doing so well over the last couple of months, remember I showed you the small cap growth versus value? Here's your answer. Look at this one. Let's click on the information technology. Look at this. I mean, it has just been flying. That's the last 30 trading days. And you can grab this and drag it back, but essentially, and that's kind of the rotation that I was talking about here. See how it goes down and lagging, improving, right back up into leading. And there it is, down into weakening. Looks horrible now, way into lagging. And then, wow, what a move. Look how far it went in 30 days. It went from leading, weakening, lagging, improving, and then all the way back into leading in 30 days. And then it just absolutely exploded. But ask yourself, CNBC, all the folks out there still talking about a recession. Why is money rotating so heavily into growth areas if the market is so concerned about a recession? I think the market's looking past whatever we have coming, if we have anything coming. The market's looking past it. And like I said, we still got cheap money. 3.75% on the 10-year Treasury yield. Still historically very low. Anyway, so that's the chart of the day. Again, if you want that, if you want to see something like that or little tidbits of information 3 times a week, go over to earningsbeats.com, scroll down, make sure you sign up for our free newsletter. If you want to try our service, there hasn't been better guidance anywhere. If there has, I'd love to see where it is or was or has been. We talked about the the bear market in 2022 before it happened. I was bearish. I know everybody in 2023 now, I get all these comments. There he is, the perma bull, always talking bullish. Well, they obviously don't do research, because 2022, I was as bearish as they get for the first 6 months. Since June of last year, yep, I've been bullish. Should I apologize for it because the S&P 500 is up 700? I don't think so. I think it's been a good call. Anyway, if you want to check out our full service, there is a 30-day free trial. We'd love to have you. Again, I think it's top-notch market guidance, research, and education. All right, let's take a quick look at what's going on in the market this morning. Market did just open. See if we're green, red. Still a little bit of a mixture right here. Small caps, though, taking the biggest brunt of the selling this morning, down about 1%. So that group is giving back some of the profits we saw but they were big profits on Friday. So we'll see. Obviously, if we go back down 4% today, I'm not going to be very happy camper. And it wouldn't look good for the small caps to do that. I don't think we're going to see something like that. I think we may see some early selling, some profit taking. I wouldn't be surprised to see the group come rallying back. The VIX back up a little bit today, but it was at 1460 on the close on Friday. So getting back up to 15, as far as I'm concerned, not really that big a deal. NASDAQ showing a little bit of leadership this morning. We'll see whether or not that continues. You can see Tesla over here making a nice move, 668. That's probably helping the consumer discretionary area as well. Moderna on the list. Maybe we'll see some additional follow through in some of the healthcare stocks as well. Anyway, that's it for me. Appreciate you tuning in. I'll be back tomorrow over at Stock Charts TV at 9 a.m. Just simply go over to Stock Charts, click on the Stock Charts TV link at 9 a.m. and be sure to join me for our next episode of Trading Places Live. Have a great day, everybody. Happy trading.